I'm going to spend a little time just talking first about the Wells Fargo real estate franchise, and then follow up with the discussion on commercial real estate finance, both for the owner-user as well as the investor and professional real estate developer. First, the Wells Fargo real estate franchise. In 2009, Wells Fargo originated over $27 billion of commercial real estate transaction through the various lines of business represented above. Real estate banking group, which works with our REITs and large national firms. Real estate capital markets group, which originates loans for the CMBS platform. Our multifamily capital team, which works with the Fannie, Freddie, and various HUD programs. Our community lending and investment groups, which works with the affordable housing and tax credit programs. Eastdil Secured, which is the real estate investment banking platform of the bank. Middle Market Real Estate Group, which works with local and regional and private developers. Our Reno office is headed by Susan Klein here. The commercial bank working with mid and large size companies. The wealth management group representing the high net worth segment. And finally, the business banking platform, which works with small to mid-sized companies. The following chart was put together by the Mortgage Bankers Association and demonstrates that the $27 billion in originations that Wells Fargo put together was nearly 3 times as more as our nearest competitor. And the over 7,700 transactions was more than the top 10 competitors combined. Wells Fargo is the #1 lender for office property, multifamily property, affordable housing, retail, industrial, hospitality, healthcare. We're the #1 portfolio lender, the #1 FHA lender, and the #2 Fannie and Freddie lender. This map demonstrates the coast-to-coast U.S. presence. Each of the offices listed here has a specific commercial real estate finance discipline they attend to. Okay, enough about Wells Fargo, right? Let's talk about real estate loans that are available today. The first platform we're going to discuss is the owner-occupied real estate loans. Owner-occupied real estate loans are first and foremost about the health and stability of the underlying business that will occupy that real estate. So business profitability, cash flow, balance sheet, their liquidity, leverage, equity position, the historical performance through economic cycles are all important when it comes to owner-occupied finance. Options available to small business owners include SBA loans. Most small businesses are eligible. SBA programs exist for the purchase, construction, and refinance of commercial property. Loan sizes are generally less than $5 million, rates in the 5.5% to 8% range. 25-year amortizations are available with loan terms of 20 and 25 years. Probably one of the most important components today is the 90% loan to value that's available through SBA programs. And with valuations being difficult today, this presents a unique opportunity. On the conventional owner-occupied side, loan sizes are unlimited, limited only by the business's ability to qualify. Generally, terms are shorter, 5 and 10-year terms, and with loan values up to 80%. So let's talk for a moment about loans for the professional real estate investor or the professional real estate developer. These projects are most directly related to the reliability of the income stream that's generated by that particular asset. So factors including market supply and demand, trends in rental rates, location, the overall quality and design of the project become important. If you're fortunate enough today to have a stabilized asset, then there's been a reemergence of the CMBS platform. CMBS platform provides non-recourse fixed-rate term loans to owners of stabilized income property. Rates today are very attractive in the 4.5% to 6% range, and again, provide a nice attractive option with non-recourse financing. While most lenders in the CMBS platform are focused on loans in excess of $10 million, Wells Fargo has recently introduced a small loan program focusing on projects in the range of $1 to $5 million. Underwriting qualifications are very similar. There's slightly lower loan-to-value requirements with streamlined and a more efficient transaction cost. On the bank platform, again, similar underwriting for stabilized income property. Generally speaking, there's more flexibility around loan-to-value. debt coverage ratios, prepayments, impounds, etc., because of the recourse component that's required on the bank platform. If you're not fortunate enough to own a stabilized income property today, or you're looking to acquire an asset that is not stabilized, we have the ability to look at bridge or rehabilitation financing. Again, these transactions are highly customized to the borrower and the specific transaction, generally providing a term of 1 to 3 years to provide an opportunity to stabilize that asset. Recourse is required, and again, highly customized depending upon the specifics of each individual transaction. Finally, if you're looking for construction or development loans today, basically the key for a construction or development loan in today's market is putting together a strong, experienced development team with strong financial support from the guarantors, including a strong equity position in the project. Build to suit or strong pre-leasing is necessary to help mitigate the risk of new development in today's market. And that's all that I have. Thank you.